There comes a point in almost everyone's financial journey that feels different from every dollar that came before it. Not because it changes your life overnight, but because it changes the way you think. Let's imagine someone named Oliver. He's 32 years old. He earns a decent salary. Nothing extraordinary. For the last few years, he's done all the things that rarely get noticed. He packed lunches instead of eating out. He drove the same reliable car while his friends upgraded theirs. He invested a little every month, even when it didn't feel like it was making much of a difference. Most days it felt slow, almost too slow. Then one afternoon during his lunch break, Oliver opens his investment account like he always does. And for the first time, he sees 6 digits, $100,184. He stares at the screen for a few seconds, refreshes the page, then smiles. Not because he suddenly feels rich, but because this number once felt impossible. The strange part is what happens next. The excitement fades surprisingly quickly, and a new feeling takes its place. What do I do now? If you've ever wondered why the first $100,000 is such a big milestone, or you're trying to reach it yourself, consider subscribing. Now back to Oliver. Almost immediately, everyone seems to have advice. One friend tells him to buy real estate. Another says, this is the perfect time to invest in the next big technology company. Someone online insists he's missing out if he isn't buying crypto. And a small voice in Oliver's own head says something even more tempting. You've worked hard for this. Maybe it's finally time to enjoy it. That thought sounds harmless. In fact, it sounds completely reasonable. But moments like this often decide far more than people realize. Because reaching $100,000 isn't the finish line. It's the point where many people accidentally slow down. Some become too cautious and stop investing altogether. Others suddenly take risks they would have never considered before. And many simply start spending more because they feel like they've finally made it. The surprising thing is that none of those decisions feel reckless while you're making them. They feel earned. And that's exactly why they're so dangerous. Because the first $100,000 doesn't change your financial future by itself. The decisions you make after reaching it do. And to understand why, you first need to understand what actually changes once your investments reach 6 figures. So what actually changes once you reach $100,000? At first glance, nothing. You wake up the next morning, go to work, pay the same bills, live in the same house. From the outside, your life looks exactly the same. But underneath the surface, something important has changed. For years, Oliver felt like every dollar in his investment account came directly from his own effort. If he wanted more money, he had to work more, save more, earn more. His progress depended almost entirely on him. But once his portfolio reached 6 figures, it quietly started doing something on its own. It started working. Imagine your investments earning an average annual return of around 8%. On a portfolio worth $100,000, that's roughly $8,000 in growth over a year on average. Oliver didn't work overtime for that money. He didn't ask for a raise. His investments simply kept growing while he was busy living his life. That's the part many people don't fully appreciate. At first, your savings feel like a bucket you're filling 1 cup at a time, but eventually the bucket starts filling itself. Not all at once, not magically, but enough that you begin to notice. And that's why so many experienced investors call the first $100,000 the hardest. Not because the next $100,000 is guaranteed, but because compounding finally has enough to work with. Think about pushing a heavy boulder up a hill. The beginning is exhausting. Every step feels slow. You wonder if you're making any progress at all. Then eventually, you reach the top. From there, the boulder doesn't stop needing guidance, but it no longer relies entirely on your strength to keep moving. That's what changes. Oliver isn't just saving money anymore. He's building momentum. And momentum changes the game. The mistake is assuming you've reached the destination. In reality, you've only reached the point where the journey starts becoming easier. That's why the months after reaching $100,000 matter so much, because this is when people usually make one of two mistakes. They either become so protective of the money that they stop letting it grow, or they become so confident that they start taking unnecessary risks. Neither one is driven by logic. Both are driven by emotion. And understanding those emotions is far more important than finding the next perfect investment. Because when your money finally starts working for you, your biggest challenge is no longer building momentum, it's making sure you don't accidentally interrupt it. This is where Oliver's story could go in three very different directions. And interestingly, none of them look like mistakes at first. The first is playing it too safe. Oliver spent years building his portfolio. Now that it's finally reached $100,000, he becomes afraid of losing it. So he leaves most of it sitting in cash. It feels responsible. After all, the money can't go down if it isn't invested, but there's a hidden cost to feeling safe. While inflation quietly pushes prices higher, his money loses purchasing power without him even noticing. The balance on the screen barely changes, but what that money can actually buy slowly shrinks. The second mistake is almost the opposite. Instead of becoming too cautious, Oliver becomes too confident. Suddenly, every headline promises the next big opportunity. Artificial intelligence. Crypto. The stock that's supposedly going to double by next year. After spending years investing patiently, he starts believing he needs something more exciting, something faster. But history shows that consistently chasing the next big thing usually leads to buying high, selling low, and constantly jumping from one investment to another. Ironically, the biggest threat to long-term investing is often the feeling that you need to do something. Sometimes the hardest decision is doing nothing at all. Then there's the third mistake, and it's probably the most common. Oliver looks at his account and thinks, I've earned this. He upgrades his apartment, starts eating out more often, maybe buys a nicer car. None of those decisions are extreme. They're simply small lifestyle upgrades. But over time, they become his new normal. Before long, the extra money that once went into investments quietly disappears into a higher cost of living. Psychologists sometimes call this the arrival effect. We believe reaching a goal will permanently change how we feel. But after a few weeks, our expectations adjust, the excitement fades, and what once felt like success simply becomes everyday life. That's why so many people work incredibly hard to reach $100,000, only to stop the very habits that got them there. Not because they failed, because they believed they had finally arrived. But the truth is, $100,000 isn't the finish line. It's the point where your money finally starts helping you build the next $100,000. The people who become truly wealthy usually aren't the ones who find a secret investment. They're the ones who protect the momentum they've already created, because once momentum is lost, it's much harder to build again. And that's exactly what Oliver is about to discover. So what should Oliver actually do? The answer is surprisingly boring. And that's exactly why it works. He doesn't need to find the next big stock. He doesn't need to predict the market. And he definitely doesn't need to rebuild the strategy that got him here. He simply needs to keep doing what worked. Keep investing consistently. Keep his lifestyle from growing faster than his income. And most importantly, let time do more of the work. Because that's what the first $100,000 really buys you. Not a luxury lifestyle, not financial independence, it buys you momentum. For the first time, your money begins contributing in a meaningful way. Every year, the portfolio has the chance to generate more growth than it did the year before. Not because you're working harder, but because you've already built the foundation. That's why the second $100,000 often arrives much faster than the first, and the third faster than the second. Not because investing suddenly becomes easier, but because compounding finally has enough time and enough money to do what it's designed to do. The mistake is thinking you need to become a different investor after reaching six figures. In reality, you probably need to become a more patient one, because wealth is rarely built by constantly changing direction. It's built by staying the course long enough for small gains to become meaningful ones. Oliver eventually realizes something that completely changes the way he thinks about money. The first $100,000 wasn't the reward. It was the engine. Everything before that was about building it. Everything after that is about not turning it off. And maybe that's the biggest lesson in personal finance. The hardest part isn't reaching an important milestone. It's believing that the same quiet habits that got you there are still the ones that will carry you the rest of the way. Because in the end, wealth usually isn't created by dramatic decisions. It's created by ordinary decisions, repeated consistently, for far longer than most people are willing to wait.